wage increase.
That's real wage growth, yeah. So you need to talk to Treasury about the detail of their wage forecasts, but we've seen real wage growth over the last 3 or 4 years, and we would expect that to continue. I think, there's many New Zealanders who haven't actually had real wage growth in the last few years, and they will be expecting that in a stronger economy, where businesses are confident that they will get the wage increases they're waiting for. I think that's an inherent part of the cycle.
How do you guarantee they will get those wage increases?
Well, we can't guarantee it. They'll have to work it through with their businesses, but I think the prospects for lifts in income are pretty good. The economy's been through a phase of rebasing its productivity. The labour market's been pretty resilient, and it puts businesses and their staff in a pretty good position to share the benefits of growth. And that'll be, I think anyone who's running a business should expect that.
What then is your message for households who are now preparing for interest rate rises with under the hope of wage increases?
Well, I think the same answer as to Corin, really. The prospects in an economy that's growing at 2.5 to 3.5% for wage growth are much better than they were 2 or 3 years ago. There'll be better job security, you've got more productive businesses, you've got an export sector, a construction sector, and now a service sector who are more confident than they've been for 10 years. So as we face the inevitability of rising interest rates in a well-performing economy, I think for those households, it's not news. They've been generally been pretty careful about their debt levels because of the likelihood interest rates are going to go up. And alongside that, they've got this, reasonable prospects for wage increases. So what they do need to look out for, though, is government policy that might push up that inflation and interest rate structure faster than is necessary by not dealing with the housing issues or by unmanaged government spending increases.
But in layman's terms, what should those families be doing right now?
What should they be doing? Well, if they can get their debt down, it would help to get their debt down. Otherwise, I think they've done all the things they can do. They've reorganised their workplaces and their household affairs. Their debt levels are pretty moderate, and they should have a bit of confidence that with better job security, better productivity, there's a prospect of better wage increases as well.
There's a point made several times here that households will be comfortable with their debt once again, but you seem to be saying that don't get too comfortable. I suppose for all the policy questions, are you comfortable with their debt levels? And if so, why?
Look, by international standards, our household debt levels are still high. What we're going to see in this cycle is, with a significant majority of mortgages on floating rates, any shift in the interest rate by the Reserve Bank is going to feed through pretty quickly. And I think households will show the same kind of resilience to that as they did to the bigger threats they've dealt with over the last few years, which was the threat of losing their job, the problem of no wage increases sometimes for 2 or 3 years. So I think they're in pretty good shape to handle it.
Minister, in the 14-15 year, you've got a real growth of 3.6%, nominal GDP growing at 5%, but no increase in the overbill. So where's the extra tax? What's offsetting the rise in the tax take you'd expect with that sort of underlying growth in the economy?
Yeah, there's a table in there that sets out the offsets for this forecast period. So you need to keep in mind that Treasury already had reasonably strong forecasts for that year, probably a bit stronger than people recall. So the uplift in tax revenue is there, but it's not very large. On the other hand, there's always these kind of one-off factors which I referred to a few weeks ago at the post-cabinet presser that you can't always predict. So one, which is expressed in the table, is that the way the government accounting works, and there's no, it's not, these things aren't always obvious, is when New Zealand Super and ACC change their mix of financial instruments away from debt towards equities, we record a lower interest income in the government's books, and that has knocked, a few $100 million off the surplus.
Is it a conservative forecast like the 86?
Is it a conservative forecast? Well, it is the forecast. You can talk to Treasury about whether it's conservative. I think that the GDP forecasts look to me to be about middle of the pack. There'll be a question over whether, I think in the minds of all forecasters, about the extent of this uplift in the last 6 months or so and how that will feed through. But look, I think this discussion shows the limits of a point target when there's so many things moving around. So as we get to surplus, we will be, we're rethinking rethinking the fiscal targets just to ensure that we don't become prisoner to the variability in things we can't control. I mean, that's a bit of a more technical discussion will go on in the background to the budget.
Do you think, therefore, because of these new financial assets and liabilities and moving that OBG around, it's time to have another look at what actually makes up OBG and come up with something that's not profited by these one-off factors?
Well, the OBGOL was created by Dr. Cullen precisely to remove a fair bit of that volatility, but there's still some in there. I think what's come out of the investment statement is something that I think is not that well understood. The biggest share and fastest growing part of the government's assets are shares and are equities and bonds, a lot of them offshore. Right? So the government's been replacing commercial assets essentially with financial assets. And the values of those financial assets and the flows associated with them fluctuate a lot. You just got to look at the record returns from the super fund this year, 25% or 22%. There's every reason to believe they'll have years where they get zero returns when they're a very long-term fund. So we are having a bit of a think about it as the commercial part of the government's balance sheet shrinks and the financial part grows. It does affect our operating balance, and there may be some, subtle changes that could occur there. But in the end, it's just a measure of underlying activity, and our main focus is not on the measurement, although that matters, but on getting results from the underlying government spending and managing the risks of the government now being by far the largest holder of stock market product in New Zealand.
The surplus you've got of $5 billion in 2018, would you expect that once you have paid off the paid off your firms and those sorts of things, that some of that money would be your instinct to return that money to New Zealand?
Well, as I've said, we haven't got ahead of ourselves because we're still looking at in the next 18 months a paper thin surplus, and we've still got to get there. And that's why I've talked in here about New Zealand, making sure New Zealand's got choices. And you can see what those choices are: to restart saving for the future, say through the super fund, perhaps to rebuild some of our buffers against natural disasters because we've had that cleaned out, to pay off debt, and a discussion about how low that could get, and we could comfortably pay off, spend the next 5 years paying off $50 billion of debt, which will get us back to where we started in 2008, and investing in effective public services. And I think the most important part of that, the most challenging part of that is getting a strong focus on the effectiveness of public services and moving away from the usual political circus around throwing billions around just because you've got it. So that's where a fair bit of our efforts go.
You were actually one of the critics of Dr. Cullen, and he was working out services of that magnitude, calling for tax cuts and for that money to go back to Kiwi. So you've got the right-wing party, surely your instincts are to give that money back to New Zealand.
Well, we don't have it yet, but it's still a forecast. What we have, although bear in mind, what we have talked about since the last budget is reductions in ACC. So In this half-year update, we've confirmed a reduction of around 350 million on 1 April 2014, and then a billion reduction around, which is not confirmed but is in the pipeline, a billion reduction projected for the 1st of April 2014. So, that's related to the fact that ACC is fully funded, but it is returning revenue back to businesses and households. And if we called it a billion dollar tax cut, I think people would get excited. But you call it a $1 billion reduction on ACC levies, they just think, oh, they shouldn't have been taking it off me anyway. But that process is underway.
Will we see tax cuts in next year's budget?
Honestly, can't tell you. I think it's unlikely, but because the surpluses are still relatively small. I mean, I need Treasury to be telling me that there's significantly larger surpluses.
What about senior initiatives in a couple of years, paid parental leave and auto enrollment in KiwiSaver? Are they likely as elements in budget 2007?
Look, again, I wouldn't want to prejudge those particular propositions. They're around. In fact, the auto enrolment proposition was in the 2012 budget. But what we've, the discipline that we've now got, spending discipline across the public service, means that even with relatively small increases in spending, we have some choices about where money can go. There's a few areas where there's always a pretty compelling case for more, like health. But we've been making quite active choices around the investment approach in welfare, into which we put a few $100 million in the last couple of budgets, around quality in education. We've done a very big exercise around the sustainability of the defence forces, and that's going to need to be funded. There's these propositions that you've mentioned, so that's why we have budgets to sort through them.
Are they both likely, paid parental leave and auto enrollment? They sort of things that we come up in next year's budget?
Look, I wouldn't use the term likely. I just think that's getting ahead of us. I think the point is this: the spending discipline is sufficient that we can make choices within the allowances that we've got.
Just on the asset sale program, Mr. English, in the document today we've got a net impact on Overgo of $108 million a year. Negative impact, if you like, less, $108 million less. As far as I can tell, that's compared with, say, $49 million for the first full year following the completion of the program. Is that a disappointment to you? And why shouldn't it be a disappointment to New Zealanders?
Well, look, I'm not exactly sure which numbers you're referring to. There is, I think it's to do with the dividends and so on, isn't it?
It's basically foregone profits offset by reduced finance costs.
Yeah. So, look, I don't set a lot of store by people estimating foregone profits of risky commercial businesses. And there's been a bit of a game over the last couple of years to assert that all these companies are government-owned were going to make hundreds of millions of dollars, which would come back to the Crown. Well, just go and look at the share prices, because people who own the market, who's looked at the share prices, doesn't feel that it's dealing with companies that make endless amounts of profits virtually at will. So there's a whole lot of theoretical calculations. These are risky commercial businesses, and where they make more money than the cost of debt, those income flows are at risk. That's why they have to make more money than the cost of debt. And we're happy as the Crown to be reducing our exposure to risky commercial businesses and getting a lot better at dealing with our exposure to things that no one else can deal with, like the risk of natural disasters, the risk of social failure, the risk of long-term welfare dependency. And just, our opposition remain obsessed with owning a few electricity companies. Well, as we've proven, anyone can own them. But only the government can do the core functions of being the balance sheet of last resort for New Zealanders and managing those who are most vulnerable. And actually, that's what we're focused on.
It says in here the government has indemnified the Meridian directors. Why is that?
I just have to check exactly what it's referring to, but in the process of sale, there is a sort of standard set of indemnities that are given, so that directors are comfortable about proceeding through the sale process. So it's not significant.
And just on another issue, domestic sales, Genesis, what have been your most up-to-date conversations with Iwi and Hapu, and do you still see potential legal issues there?
Oh, look, there's always potential for legal issues. We've been round, I've had a pretty recent update on all the conversations with it, because I went round and did a series of consultation with various iwi, and some of them are pretty relaxed about the impact of relaxed about the fact that the sales process has no real impact on their property rights. There'll be others who may see it as an opportunity to assert rights, either against the Crown or with respect to larger groupings they're part of. And there's a few of those in the sort of Genesis contiguous areas. So you never quite know. What we've found generally is that we've built a pretty constructive relationship with iwi around these sales. They're fully aware, as we are, that at any time they can take legal action to prevent them if they can assert a legal right. Our obligation, we've had an obligation supervised by the Supreme Court to go round and make sure that no action we're taking compromises a right that they might want to contest.
So how recently have you had these discussions where you and Hapu that they may be to assert rights in relation to Genesis?
Well, look, I wouldn't say anyone has formally said that. All I'm saying, well, 3 weeks ago, I went round and did a series of hui in Karingwana on hui in Hamilton. And you just, I mean, in the discussion that's there, these are audiences who are fully versed in property rights arguments and their own history about their claims against each other and against the Crown. And so in those discussions, there's always people signalling some sort of dissatisfaction. I have to say the overall tone of it, though, was pretty positive. And as we've been through 3 or 4 rounds of hui, there's now a very good understanding of the process. And we've found that iwi are more interested in the long-term program around freshwater quality, allocation of consents, all that sort of thing. And they see some of them see the asset sales as an opportunity to get some leverage on that process, but it's not their main focus.
When they were talking about options for surfaces, one of the other things you mentioned was perhaps rebuilding buffers in EQC. I just wonder about the use of the word perhaps there. Does that mean that's under review?
Yeah, well, EQC is under review in 2 respects. One is the details of the coverage, because there's been an awful lot learned about what the law does or doesn't mean, or what it doesn't define in Christchurch. And then there's the other part of it is that if the Crown is the insurer of last resort, then do we need to have a separate fund? Could you support it just with your normal borrowing capacity, which is what we ended up doing anyway? Okay, there was $6 billion in the fund, quite a bit of it was government bonds, and then we got and borrowed, I think, another $7 billion under a guarantee of EQC. So that's more of it's more about, it's not to do with customers, because their coverage will be redefined and underwritten. It'll be about access to reinsurance and what are the most sensible arrangements on this balance sheet.
So I think you've actually managed to significantly increase New Zealand's productivity, or the total speed limit of the economy. You've got growth coming back to 2% by 2017, given the Christchurch rebuild, strip that out. I mean, we're not exactly getting back to optimum speed, are we?
Well, it's an interesting issue. The official advice is that the speed limit is around 2.5%, a bit lower than it's been at some stages, such as the late 90s. The reason the advice is that because you've had the recession actually now stretching back to 2007, you've had lower levels of investment, though, and as a result of those lower levels of investment, you've tended to get some lower productivity. The productivity lowered, but now they're picking up, and you've had a microeconomic reform, then we would expect that speed limit to lift a bit. The obvious signs of strain around that speed limit are the housing market, where we believe that the constraints on supply are a real risk to this economy. It could become quite unbalanced if we. So that's why we're working so hard with councils to get them to make decisions that are in the interests of the whole country as well as their community, and that is expand the supply of housing to meet the demand. So that's one major constraint, and another increasing one is around skills. So as this economy picks up, unemployment in the South Island is already about 4%, and particular skill groups are in short supply. So those are a couple of constraints to keep the speed limit down in the next wee while, and that's why we're working on them.
On the Canterbury rebuild forecasts, there's an increase here for the Southern Response Support Package to 360 million from 200 million. What's going on there?
You need to talk to the Treasury about the detail of it, but they would have gone through a process of revaluing the future liability for Southern Response, and I think, and I can't tell you exactly what the features that are going to be. What we know is generically that those insurance companies face cost escalation, which could be tending to push their future costs up, and that should be an incentive for them to get on and settle.
And elsewhere there's a forecast now that other SOE claims fees will have an extra cost of 500 million, up from 66 million.
Look, I'm not sure which figure you're referring to. The one in the, once you take out the electricity companies, the rest of the SOEs generate relatively little income, and that's because they all have their own challenges. And the next one where we'll have to have, where we need to have another think is Kiwi Rail, which has performed pretty well, but it has had a lot of headwinds, like the Christchurch earthquake, other natural disasters had a big impact on them, and the Aratiri problem. So that may be part of what's referred to there.
And on the tradable versus non-tradable thing, you say it's been improved since 2009, but the last year or so shows a diverging. Are you worried about how soon do we have to really make a difference before you say actually the long-term forecast of increasing export share to 40% by 2025?
Well, we don't get too focused on the measure, because the measure is constructed by the Department of Statistics and reflects a set of assumptions that they make about, for instance, what proportion of the transport industry is related to exports and what the proportion is related to domestic. But what our concern there is the general trend, which has been the non-tradable sector growing faster. Now, there's a bit of a shift now, partly because of the high terms of trade, where the export sector is doing a bit better. But there's two significant factors which we hope, where we can see changing over the next 2 or 3 years. One is just the draw of resources into the Canterbury rebuild. Much as it's supporting some growth now, it is drawing a lot of resources back to rebuilding, literally, the capital of Canterbury, of Christchurch, when that kind of resource would have been available to flow to the export sector. So that's one headwind. We will eventually rebuild Christchurch, and that hole will be filled, and resource can then flow. But it is going to have a 5 to 7 year impact. And the other, of course, has been the exchange rate. And I think our exporters have done incredibly well to be profitable, viable and competitive when they've faced a pretty high exchange rate now for 6 or 7 years.
The net international investment position in your forecast is growth in the deficit of 72% of GDP to 83%. Isn't that worrying? getting more inverted in the future?
Well, look, we want that to do better. I have to say that we've performed generally better than the Treasury forecast for the last 3 or 4 years. The current account deficit has tended to be lower than they expected, and the net investment position has tended to be a bit better than they expected. I think this is, I think, simply underlines the point about persistence. Now, New Zealand has a habit of making some progress because it's been energised by things like recessions and restructurings. And then as soon as there's some signs of progress, in the past we put our feet up and decided that's good enough. Our approach is to be less drastic in policy change, more moderate but more persistent. And it's certainly our view that if we continue with considered management of the government's books, not necessarily endlessly too tight, and persistent microeconomic reform, get through the Canterbury rebuild, then we've got some real opportunity to build off the dynamism of the Asia Pacific region and actually shift those balances. But it does mean persisting for a while. Economies take quite a long time to change.
So what's the message?
Funding increases, excuse me, for the exports. Why is that? And is that a admission perhaps that the budget cuts are saying it's too much too fast?
No, it isn't. It's because we've been through a very thorough exercise of really understanding what it costs to have the capacity that the New Zealand government wants the Defence Forces to have. And I'd have to say the Defence Forces themselves have done a very good job, probably better than almost any other government agency, of really getting down to a granular understanding of what activities are there and what each one of them costs. The result of that is, in the white paper process, in the strategic review, and the DMRR, is a long-term plan that matches capacity and funding. And the trade-off is that the defence should have a reasonably stable environment for the next 10 years, because we know what we want and why we want it, and we know what it really is going to cost. So that will, and the Minister's made some announcements about that, and it will unfold further through the budget.
Is that suggesting that it's been unstable over the last few years during the savings program?
Well, they've had a lot going on. The moving out of Afghanistan after what's been 10 years of engagement, so you've had defence forces that have been reasonably, very stretched by a decade, a very intensive decade actually. And they've been through trying to renew a lot of their equipment, move from essentially 3 forces into one back office. They have seen the opportunity to make significant savings, and they've made them. And they've had a hard think about what they're doing. So, yeah, they've been through a time of real change, but they are buying a pretty secure future, a more stable future for themselves.
Mr. Davis, what's your message to the Christmas shoppers this year in the malls? Should, on the basis of these numbers, they be feeling more confident about coming through with things and stuff?
Well, look, it's, the indications are they are feeling a bit more confident. But look, I don't think they're going to get carried away. Kiwis have got pretty realistic over the last few years, and they know that if they overdo it now, they're going to pay later when the kids start back at school. But why shouldn't they have a bit of confidence? They've been through a pretty tough time. They've done well. They can see things looking up. I hope they enjoy Christmas.
So a little bit of a spin, that's all right?
Well, a little bit of confidence is a good thing, isn't it?
I'm just going with the big school, sorry. Why is it that they need more money now after this program of savings?
It's to do, a lot of it's to do with the build-up of the capital purchases they've made. So they've been buying new helicopters, they've been upgrading the frigate, and all that is building their capacity, but it also builds higher costs. And so we've been just making sure we get a really good grip on it, because the one thing that's debilitating for them, as it is for other public services, is when they find themselves continuously dealing with budget shortfalls, changing political decisions, uncertainty about what they're trying to achieve. So we've tried to work all that through intensively over the last 2 or 3 years, and what it's shown is that to have the capacity that is now, I think, pretty much bipartisan. It's got a certain cost. We know they've worked hard, so we're not suspicious that they're trying to pad it out, and they understand it much better, so they can face the future with a lot more confidence.
How much more are they likely to use?
I honestly couldn't tell you off right now, but it's an area where there will be some increases. And I think, look, that reflects the way the government's gone about its fiscal management. We're not just mindlessly saying no to everything. We've been having a pretty hard look at all the functions of government, making sure they understand their own business, being very